How's it going, guys? Liam here from AltSignals. Today we're going to be taking you through some of the top reversal patterns, what to look out for, how you can spot them, and what you should be doing when you see these patterns. As always, if you could give us a like, subscribe, hit that notification bell, and let's get into it.
AltSignals.io.
Okay, so here we are in the chart. So what we'll do is we'll go through the bullish patterns and then we'll go through the bearish patterns. So what we're looking at here is reversal patterns. So something that happens, the price is going to change or reverse. So first we have the double bottom. What we're looking for is two bottoms, as you can see here, on within the same area. So if you find that there is some support, or there's a support level, and also what we call a neckline, which is a level where it plays as resistance to a certain point. So we see the price come down, then we find an area of support, the price moves back up, hits a resistance level, comes back down and bounces off the same area of support. Now what we would wait for is it to break this resistance level and place our entry above that and place our stop loss below the previous resistance in case of a reversal back down. So this would be a straightforward, there's a double bottom, two areas of support playing there, there's a key area of resistance played there, we see a breakthrough on that key area of resistance, we place our entry and we place our stop loss way below there, as you can see. Then we've got the falling wedge. So again we see a decline in price, a drop in price, and what we're going to start to form is a lower high. So as you can see here, the first high, second high, third high, and it forms this wedge. Basically the bottom is playing along with the top, as you can see, forming that wedge. So again, what we would look for is this particular pattern within a wedge, at which stage what we'd look to do is place an entry point just of the breakout of that wedge and a stop loss below the bottom of that wedge as well. And again, the same would apply. So we would expect a breakout. As soon as we see that breakout and it passes that initial level, we would place our trade. Then you've got inverse head and shoulders. So what this is essentially is, as the wording is, head and shoulders. So these are the shoulders and this is the head. So again, we see a decline in price. We have a resistance area here and we have two areas of interest. So we see that the first area of interest is here, then we see that the increase in price hits that resistance level, and then we see a further drop in price, so it breaks through the initial support level that we saw here, and once it hits this key area of support, again we see the price drive back up, still hits the same resistance area as it has before, and then we'll see a price come down to essentially the same area of support from the beginning. That would be the key area that we'd look for. It won't be exactly like this. We'll show you some examples, but if that happens and we see the price come down and we start to see it to start rise, we wouldn't place our trade until it breaks through that resistance. Then we place our entry and we put our stop loss just above the support that it's bounced off of from the initial trade. Now let's look at bearish. So again, it's basically the same but opposite. So as you can see here, we've got a double top. So the same happens here. So we see a key area of resistance and then we've got an area of support. So the price rises, it hits a resistance level, comes down and we see an area of support playing there. Price rises back up, the key area of resistance has been hit again, and then we see a price come back down. Once the price breaks through this previous support, that's where we place our entry for a short, and we'd have a stop loss above the previous area of support as well. Then we have the rising wedge. So again, same applied, but it's the opposite way around. So the price rises, we see higher highs, and again the movement in price gets smaller, as you can see, and that's how the wedge is formed. And again, the same thing happens here. So we have an area of resistance and we have this trend line, and essentially what we're seeing is this price continue to rise up, but the movement in price is not as big as the beginning here. So once this area is hit and we see it break through this key area of resistance, again we place our entry for a short and we'd have the stop loss above the previous resistance area there as well. And then finally we've got the head and shoulders. So again, what we'd be looking for is an area of support and two areas of resistance. So the first is the initial area of support here. So the first shoulder is formed, then we see a price rise to a new area of resistance, and then we see a decline in price again down to the previous support level, and then we would move back up to the initial key area of resistance, forming the head and shoulders, at which stage we'd wait for the price to break through the support level, and we place our entry for a short, and then we'd have our stop loss again above the support level as well. So here are a few examples. So here's a double top. So you can see here, price rises, we see it hit this area and its key area of resistance, it comes down, and then we see a price rise again, and at this point what we're looking for is this level here, this level right here. So we wouldn't be looking to place our trade until we get to about here. So the price hits this initial support again. As you can see, it's not very straightforward where it's up and down and then straight through. We see this double top area here, we see the area of resistance hit twice, and again the third time we don't see anything. So as you can see, what happens is this price starts to break down. As soon as it breaks through that support level, we place our trade here and our stop loss will be here. Here we have the rising wedge. So as you can see, the price rises and we see the price movement start to get smaller and smaller, and again we see these three areas and these three areas here. As soon as the price breaks through this initial line here, we see what we do is we will place our trade here for a short. Here's an example of an inverse head and shoulders. So again, you can see how it's not exactly clear, but again we see a decline in price, we see an area of support, again hits this initial resistance level, a new area of support is found here, a price rises back up to this resistance level, we see this price come down in the same support area as in this one, and then we see the price break through the previous resistance level, and we will place our trade here with our stop loss around here. So hopefully that was a nice and easy breakdown of the top reversal patterns that you can find in the charts. If you'd like to know more information or you'd like to contact us, please reach out to us at AltSignals.io. We offer signal services as well as an indicator that you can purchase, and you can do your own trading and back testing on that as well. So as always guys, if you could give us a like, subscribe, hit that notification bell, and we'll catch you in the next video.